Hey guys, how are you doing? This is Peter, the lead instructor for Peter's Orb Academy. So you are welcome to this channel. Thank you for stopping by. Alright, this video is to guide you on market structures, to understand what market structures is by understanding support and resistance, and also to understand Fibonacci, how to use your Fibonacci tool, and also support and resistance and market structures. Okay, let's get straight. Don't mind this. Don't mind this is for senior secondary school students. So right, in the market, imagine you going to the market. There are three things that people go to do in the market. So people go and buy things from the market. Some people go and sell in the market. And the third category of people that goes to the market are observers. Maybe they go to price some things, to go and just play around, or to go and toast girls. I don't know. So in the market, we have trending market because why? They are active involvement of buyers and sellers. That's why we call it trending market. So there is the active involvement of buyers and sellers. That is what makes it trending. When you hear that a news is trending in a country, in Nigeria that I'm from, you hear that means everybody is talking about it. Everybody is talking about it. So we have three types of market. The first is trending market. And we have two types of trending market. We have the uptrend, meaning that the market is trending upwards, or downtrend, meaning that the market is trending downwards. Okay, so uptrend can also be called bullish, and downtrend can also be called bearish. I don't know, maybe you understand what I'm saying. So uptrend can be called bullish market, and downtrend can be called bearish market. So if you hear me start saying bearish, the market is bearish, just know that I still mean downtrend. If you hear me say the market is bullish, just make understand that I'm saying uptrend. So we have three types of market. We have the trending market, which is we have bullish and bearish market. So we have the ranging market, which is the second market, and we have choppy market. Remember, another word for ranging market is consolidating market, which you also see me writing, or sideways market. You will understand as time goes on. And the third is choppy market. So let me show you a diagram I just drew to illustrate the three. The trending market means that everybody is talking about this market. It's just a market that is going up, coming down, going up, coming down, going up, coming down. That means the market is just creating a series of higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs. The market is just going up continually. So that is what trending market actually means. Meaning that a market, an uptrend rather, a market that is going up. So meaning that the buyers will push it up, the sellers will not push it down or small. But the power of the sellers is not powerful. That is why it did not push it downwards more than the previous low here. But rather, the market went this way, came back down. So the sellers could not push it below this point, and then the buyers still push it again beyond the previous point. The sellers want to try, but they could not push it more. But then the buyers still push it upwards. The sellers try to push it downwards more, but the buyers still push it upwards again. The sellers try to push it down, but the buyers still push it upwards. That is what the understanding you should have on a trending and uptrend, meaning that there are active involvement of buyers and sellers, but just that the buyers are more powerful than the sellers in a uptrend. So in a downtrend, that means is the vice versa, meaning that the sellers are the ones that are more powerful. The sellers push it downwards, the buyers try to push it up, but then they are not powerful. The sellers still push it downwards. The buyers try to push it up, but they are not powerful. The sellers still push it downwards. The buyers try to push it up, but they are not powerful. The sellers try to still push it more downwards. So it's an indication that if you look at the direction, it's a market that it's a downtrend, a bearish market, meaning that the sellers are more powerful in this market. That is what makes it a downtrend, a bearish market. So that's why that's under trending market. So you can see that they are both involved in the market, but they are either putting the market either to the upward direction or to the downward direction. Now the second is the ranging market. Remember I said the three type of market here, which is the ranging market. The second is the ranging market, which is consolidating market or sideways market. That is what it means. From this point, you can see that clearly this market is moving within this point here. It's not going up, it's not coming down, it's not moving like this, or rather coming down. No, but rather the market is moving within this, from this point here, moving up, came back down, moving up, came back down, moving up, is playing within this cycle. Whatever it wants to do it within this cycle. That's what a ranging market means. Another word for ranging market is sideways market. So it's just going sideways to the sideways direction. You understand what I'm saying? It's just moving to the sideways direction. And then the third is the choppy market, a market that has no sense of direction. That's a choppy market. This kind of market is the market that you need to run away from because it will make you look as if you don't know how to trade. Just run away from choppy market. It's not tradable. Now, let me go to the chart to show you what they mean. Alright, from the chart, this is a chart example. This is a live chart, not a diagram. Now, this is what happened in the market. So you can see that clearly the market, clearly the market moved in this direction. Went up, came back down, went up, came back down, went up, came back down, went up, until the market now came down and then started coming down again. You understand? This is from this point to this point. The market was moving uptrend. You understand? It was moving uptrend. So, all right. Now, a clear example of a downtrend is maybe somewhere like this. Let's use here for example. You see that the market was coming down, came back down, went up, came back down, went up, came back down, went up, came back down. That's how the markets keep going. So the year is a clear example of a downtrend. So that's a downtrend, all right? So let me now go to the second type of market I taught you that I said is the ranging market. It's a sideways market playing within a particular range. The market playing within a particular, is it my network? Network, please don't mess up. So market playing within a particular range. I think it's my network. What's happening? Please hold on a minute, please. Alright. Market playing within a particular range. Look at this example here like this. You can see clearly that the market is playing within this particular range. The market came down here, it's just playing within this area. This is a ranging market. Playing within a support and a resistance. Let's go to support and resistance so that you understand what we've been saying since. So what is support? Support is the lowest point the market gets to before going back upward. Support is the lowest point the market gets to before going back upwards. What do I mean by that? Meaning that in a market like this, you can see support in a trending market or in a ranging market. You always find them. Support is like a floor. Like you bounce a ball on a floor pie. All of a sudden, the ground will push the ball upwards. So the ground is the support. The ceiling is the resistance. So now look at it. The market moved up to this point. Then the market now came back here. Remember I said support is the lowest point the market gets to before going back up. So this is the lowest point this market gets to before going back up. So this is our support. While resistance is the highest point the market gets to before coming back down. So this highest point, this is our resistance. The market went up again, this is resistance. The market came down, this is support. It went down up, this is resistance, came down, this is support. Went up, this is resistance. Let's try that in a bearish scenario, in a downtrend, in a bearish scenario. The market came down here, which is our support, went up, which is a resistance, came down, support, here, resistance, came down, support, here, resistance, came down, support. And there is the way we trade support and resistance. We buy at support and we sell at resistance. We buy at support and we sell at resistance. I will not write that down. So it will pay you that is watching this video and you have a way to write your note. You should be able to quickly write your note. Write it down. We buy at support, we sell at resistance. Meaning that in an uptrend like this, in a market trend like this, that this market is going up, we're expecting that, let me draw a fresh chart. In a market trend like this, we're expecting that this market is going up, went back, came here, went up, came back here, went up again. Let me join it. So we buy at support, meaning that when the market comes to this support here, I should be expecting a buy. So that means when the market moved from this direction, when the market actually moved, when the market, Sorry. Alright, let me do this again. So when the market started moving from, why am I doing all this? When the market started moving from this point here, and it came back here, you can buy, and the market went up. How do I now know the next point the market will stop before I buy? That is when you now introduce. How do you know the next place that will be your support that you will begin to buy? That is when you introduce Fibonacci 2. Fibonacci 2. Let me join it that way. Fibonacci 2 is a tool to, that's like the way it is called. Look at the name here. This is it, Fibonacci retracement. So just to know retracement, where the market will get to before the market will stop. And how do we use before the market will start going back up? How do we use Fibonacci 2? Fibonacci 2 is only used in a trending market. In a market that is trending, either upward direction or downward direction, either an uptrend or a downtrend. So we use Fibonacci 2 on a trending market. So how do I use that? So you carry your Fibonacci 2, you will place it from the support and put it at the resistance, the last high that the market gets to. So now the point you will be looking for is this 2 points, which is the 0.5. This is 0.5 level. This is 0.5 actually. Sorry. So the point I am going to be eagerly looking for is for waiting for the market to come back to this 0.5 and 618 level. So when the market comes back there, you find out that the moment the market came back there, what happened? The market started going up. The market started going up. The moment the market came back to this 618 level, 0.5 and 618 level. This is it here. What's happening? Is it my network or what? Sorry. Welcome to Nigeria. So basically, I will use Fibonacci 2. Sorry. Okay, let me try this rectangular 2. What's happening? A minute, please. I've done a lot of rubbish on my chart. Not scatter anything. See, all the things I've drawn since, it's now that it's showing. Alright, let me come again. We use our Fibonacci 2 in this way. You draw your Fibonacci 2 from this support, draw it to the resistance, okay, in the trending market. And then these are the 2 points you must pick out, 0.5 and 0.618. Look at the line there. Just look for the line and then draw it. You now use a rectangular 2. Let me come again, please. To use your Fibonacci 2, go look for a Fibonacci retracement 2. Pick it from the low, the low, and then connect it to the high of the next movement. When you are in a bullish market, you will move forward. Okay, in a bullish market, you move forward. So you draw it from here, you move forward to put it at the up there. I'm sorry if you did not understand that, you will understand this. Then I use my rectangular 2 to mark this 0.5 and this 0.618. Just mark it like this. That was why the market came back all the way to this down here and had to go back up. That's how to use a Fibonacci 2. Use a Fibonacci 2 in a trending market. The same way in a downtrend too. Let's use a live chart. Yes, let's use a live chart to explain it so that you'll be able to understand what I am saying. Let's use a live chart. If you observe here, you will find out that, how do I know that the market is going to, this market came all the way to this point here. Alright, to be able to understand this Fibonacci tool, let's use it on this chart here. So we are expecting that when the market is going, we point it from the support to a resistance. So this is our Fibonacci tool. I put it from this down here. Let's say I draw it to this resistance here. So now this is my the clear point from which I want to trade. This 0.5 and 0.618. So I'm expecting the market to come back to this down. When it comes back to this area, what I'm expecting is that the market will come back here and then we start going up. That is one of the ways we know the market, how the market will move. So eventually, when you see the market start playing out, find that the market will go back to that direction. The market will eventually come back to this direction and then to start going upward. What will happen is that the market will eventually go back up. That is one way to know that the market is going to buy. So that's one of the powerful tools that we use. These are just for the beginners class so that you'll be able to understand. Alright, so expect that whenever the market the market has gotten to the area that we pointed out. Observe what will happen. Observe what happens. See, the market has started going back upwards. So you see, Forex is not a scam, but just that some people don't want to learn. They're just giving their own bias. Now start seeing what will happen eventually. The moment the market goes to that area, observe what happens. There will be a massive push away from that area. Away from that area. See how massive the market went up. See how massive the market went up. Do you observe? Do you see? So that's how powerful the Fibonacci tool is to know where the market will get to before the market will start going back up. So that is one powerful tool. This video is going to end here. Please, I hope you have been able to learn something. I hope you're able to learn support resistance and also how to use the Fibonacci tool. Thank you. Make sure if you watch this video to this extent and you have not subscribed to this channel, that means there is something we need to check. Thank you.